Our cash flow Excel template makes it very easy for your small business to incorporate wages, salaries and the related payroll taxes, which in the UK is PAYE or pay as you earn. Let me show you how that works. We're on the data sheet and I'm just going to select a wages and salaries heading here, and I'm going to put some amounts going across. So I'm going to put £1,000 in there. And let's take it through for the first 12 months. These rows have already had the terms set for payroll split. And the payroll split means that each payment that you've entered in your forecast will be split between the net pay, in other words what's paid to the individual and what goes straight on the cash flow forecast in that month, and the tax amount, PAYE or payroll tax, that gets paid to the government, normally speaking, paid in the following month. So let's put a payroll rate in there. So you can select from the drop-down list. I'm going to select 20%. So what that does, by selecting 20%, it will split this £1,000, for example, in December 2017, 20% of it, or £200 as tax, and the balance, or 80%, £800, as being the net pay. Just quickly as an aside, if the rate you want to select is not in the drop-down list, go across to the Info tab, and here we have a selection of rates. So you can change one of these rates, and let's put in, say, 35%. Jump back here, and then you have the 35% to select. So we can select 35%. So what that will do is it will take 35% of the £1,000 as being relating to tax, and the balance, or 65%, as the net pay. So let's have a look at how that affects the profit and loss account and cash flow forecast. On the forecast profit and loss account, the total cost in the month is included because that's when it was incurred. So in December 2017 we can see £1,000 in wages and salaries costs. However, on the cash flow forecast this is slightly different. So in December we have £650, which is the net, or in this case when we selected the 35%. So 65% of the £1,000, or £650, and that's paid in the month it's incurred, and that relates to the net pay. If you look further down, you have PAYE payments, or payroll tax payments, and this represents the 35%, in this case £350. And the reason that's in the following month is because in our settings, if I jump across the Info tab, we've set when PAYE is paid in 30 days, in other words in the following month. I can set that to 60 days if I wish, and if I jump back to the cash flow forecast, you can see now that that's delayed it by another month, so it's not paid until February. You have one further option. You have what's called the payroll taxes override. So if I change that to yes, we can set our own payments, and you can either have those payments to be in addition to the standard payments, or you can have them so that it excludes the standard payments. And those are entered on the data sheet further down. Just scroll down. So we can enter those here. So I'm going to enter, say, let's further down here, let's say £1,000 there. If I have a quick look at the payroll taxes report, you can see that it's brought in the £350 deductions from each of the months. It's got an opening balance of 0, and then the PAYE in the period, and then it's got what's paid. So we had the £350 based upon the standard setting in 60 days, and then you can see in March we've got 1,350, which includes the override payment. So if I just pop back here and say yes to ignore the standard payments, and jump back to the payroll taxes report, you'll see that it's taken out all the standard payments and just left the £1,000 payment. So you can put your own payments in here of how that gets paid. We have a quick look at the balance sheet to see how that appears on the balance sheet. You'll see that the PAYE creditor at the end of each of the periods is shown. So you've got £350 at the end of December, £700 at the end of January, and so on. And at the end of March, because we've entered the £1,000 payment, it drops down and then it starts to accumulate up again. But of course, these figures here would reflect the net of what's been deducted less what's been paid. So for example, if we say that to no, and we set that back to no as well, and put our payments to 30 days, and go back to the balance sheet, you'll see that the PAYE creditor is at a constant £350 because we deduct £350 of December, which gets paid in January, and then you've got the payroll deduction in January, which gets paid in February, and so on. If your business has direct wages costs, within the cost of sales section, you can also select the payroll split option and then split out the payroll or PAYE rate here too, just in exactly the same way, so that you can have the net pay paid out in the month and then any PAYE or payroll taxes deducted and accounted for in the same way as the overhead ones were below.